Chapter 6, Indirect Methods of Reconstructing Income. In this chapter, we're going to look at how the IRS uses various techniques to try to find out if there is tax fraud involved. Are taxpayers reporting all the income they are supposed to? So let's get started. First of all, there's the direct method. And as you read through here, it's a long paragraph, I'll let you read it yourself. You're going to see that this method is used if the taxpayer has enough records the IRS can use to try to see if the actual revenue was reported correctly or not, and also look at the expenses. So this can only be used if there are actual records, like you see here, canceled checks from customers, deed records, transaction records, public records. Are there enough records to build a case whether there was correct income reported on the return or not? Now, the indirect method comes into play when there is not enough direct evidence. So we're looking at circumstantial evidence. We don't have good records. We don't have good documents. So we'll go and use the indirect method. This leads to lifestyle probes. And this gets into looking at how the taxpayer, or in the forensic accounting area, the suspect is living. Do they have a very expensive residence? Cars, boats, vacation home? Do they take exotic vacations? In other words, are they living above their means? What's their lifestyle look like? Where are they spending the money? How much money are they spending? And does that make sense according to how much income they are reporting? So this is part of the financial status audits. And again, this is the same thing. You're looking at lifestyles. Are they spending beyond their means? Now, just because someone is spending beyond their means does not mean there's fraud involved. They could have received a large inheritance. They could have received a large gift. They could be going into debt to finance all these spending habits. So it doesn't prove anything if someone is living above their means, but it does show you need to look at that situation a little bit closer. Just mention this, we will use the indirect methods. We don't have adequate books and records. The books, if there are books, do not clearly reflect income. And you can look at the others, significant increase in year-to-year net worth and so forth. Now we're looking at the IRS and how they look for tax fraud. And the IRS has developed this market segment specialization program. This is where experienced IRS examiners have developed guides, separate booklets, separate guides, and each one is for a particular kind of industry. They call it market segment. These are used for up-and-coming IRS agents to quickly learn about these various areas. So before they go audit a client in, let's say, the timber industry, they would read a guide. There's one on timber to know about what to look for. How are the records kept? What kind of special accounts do they use? How do they earn their income? What are the typical expenses? And these guides will give a list of interview questions as well. So the audit technique guides are just excellent. And like we just said, they really dig in depth for a particular industry. They're great for forensic accountants to use, even a regular accountant. Maybe bringing on a new client. Let's say they don't know much about the car dealership industry. There's a guide on that. So pick out the ATG, the Audit Technique Guide, for that industry. And sometimes these things are 20, 30, 100 pages long. A lot of good information. And these are free on the IRS website. A cash T is used as a way to try to figure out, okay, let's look at all the cash coming in, compare it to the cash going out. Is there a difference that's unexplained? That difference could be, some type of non-taxable income. In the forensic accounting area, it could be some kind of embezzled income. Let's look at a simple one. Here's a very, very simple one. Look in your textbook for a preliminary cash T, and then a few pages later, the final cash T. It will show a lot more items on let's say the debit side of the cash T, a lot more types of receipts, cash receipts and so forth, and a lot more type of expenses on the credit side. In this simple one we're looking at right now, the taxpayer had a Schedule C. I guess that's where all the income came from. Goes on the left side, so that's what I reported. My Schedule C expenses, business expenses, on the right side. And then also your personal living expenses are added to those business expenses. So this is showing that I've paid for a total of $155,000 this year, but I've only reported $120,000. We have a $35,000 difference. Where did the difference come from? This does not prove there was tax fraud, but it said I need to look into this further. This could be paid for by going into debt, already having cash on hand, gift, inheritance, something like that. So again, this doesn't prove anything. It just shows you, do I need to look at this taxpayer a little bit closer? The net worth method. Now there's quite a bit of writing on this page, so I'll let you read most of it yourself. But this method is saying, in so many words, I want to see what your net worth was, looking at all your assets, beginning of the year, end of the year. If there was an increase, you add to that increase all of your personal living expenses. And then you see, what is the difference? How much income should have been reported to account for that difference? My increase in net worth plus my personal living expenses. Let's look at the difference. And was there enough income reported to account for that? If not, could be, it again doesn't prove, but there could be tax fraud or unreported income. The source and application of funds method is very similar to the net worth method, so I will let you read that on your own. The bank deposit method would only be used if the taxpayer deposits into the bank account everything they've received. Again, if they're not, they're keeping the money someplace else, at home, in the lockbox, hidden or whatever, you're not going to use this method. But this is a quick way for the IRS to look at all the actual income that came into the bank account, all the deposits, compare that to the income reported on the tax return. Let's turn the page here and talk about an area that you read about all the time in the paper. You read about bribes and kickbacks and bid rigging, and all this is part of the procurement fraud area. More of these can be phantom vendors. We'll talk more about that in just a second. Product substitution can be where, you're working for a big company and you're working with the supplier trying to cheat your employer. So you, on paper, order a certain, let's say, quality of the product, certain quality level, but you tell the supplier, ship me the cheaper stuff, the less quality, but I'll make sure my employer pays you the high quality prices. So you're substituting the products. You ordered, on paper, high quality, and you had control over this, so you allowed the cheaper quality to come into the business, but then you had your employer pay the supplier the higher quality numbers, and you split the difference with the supplier. What do we look for? What are the red flags? Well, lack of standard invoices, request for funds to be routed to a foreign bank account. Okay, doesn't happen every day. Request checks to be made to cash or the bearer. That would be very unusual. And you can have, some kind of difference in commission rates. You may be in a situation like a government official says, okay, I want you to pay or use a certain third party or supplier. Don't find the best one that you think. I want you to use this particular company or this particular person. And then you might get into a local agent asking for a rate increase in the middle of negotiations. Now, if you're working for a large corporation, for that corporation to be able to issue a check to another business, that business has to be put on the approved vendor list. So if you can somehow, let's say, set up a fake company, this phantom company, and get that company on your employer's approved vendor list, it's going to be easier for you to get payments made to that phantom vendor, that fake company. And if you own the company, you're getting the money. So you need to make sure, the company needs to make sure that before any vendors are put on the approved vendor list, are they real companies? Are they in the phone book, internet site? Do they have a real address? So you have to be very, very careful about placing a company on the approved vendor list, because once it's there, and if it's a fake company, fraud can happen more easily. And you look at the others, make sure that, let's say the purchasing agent cannot approve the vendors. And have a hotline there if you would like. In the final slide, piercing the corporate veil. Now the corporate veil is where, hopefully, if you're the shareholder, let's say you have a small business, hopefully you are legally protected, at least your personal assets are, if something happens in the business. So if the business has debt and has to go bankrupt, then hopefully they cannot come to you personally. If there's a lawsuit in the business and the business loses that lawsuit and there's a large judgment, a large dollar judgment placed against the business, you're hoping with that corporate veil they cannot come to your personal assets. If you are a plaintiff, or let's say in the bankruptcy area, people, other businesses will try to come through the corporate veil to you personally, and they will try to take your personal bank account money, maybe try to make you sell your house to pay for the lawsuit or the debts or whatever. So you're hoping that corporate veil will protect you. But if you don't follow all the laws and regulations on keeping the company's activities separate from your personal activities, for example, you might pay for personal expenses out of the company bank account. If things like that start going on, the other side might be successful in piercing that corporate veil. And what that means is then they can come to you and make you personally pay for the corporation's debts or the lawsuit or whatever. So small businesses especially have to be very, very careful about this. So state law will probably say you must have a shareholders meeting once a year. The minutes must be recorded. Votes must be taking place. Now, if you're a small corporation, and let's say you're the only shareholder, you might skip this step. You might say, why should I have a annual shareholders meeting? I'm the only shareholder. Well, if you skip that meeting and you're not following state law, the plaintiff on the other side, if they sue your corporation, they'll say, well, you didn't treat this as a separate corporation. You didn't follow state law. I'm going to sue you as though you don't have a corporation. That's what you don't want to happen. Okay? So it's a very, very important concept for small businesses. Okay, that's it for Chapter 6, and good luck with your studies.